We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, September 19th, 2023. And I'm on, as always, with my partner, Dominick Tavella. How are you, Dom?
Doing very well, Mike. How about yourself?
I'm very well, thanks. No complaints. So we took last week off. And Dom, I think in the last 2 weeks, the market's just kind of been meandering along. Nothing too spectacular has happened one way or the other. Although the energy market has spiked a little bit. Tomorrow we get a Fed announcement. The federal government's trying to avoid a shutdown. So kind of things out there. But right now the market, and I feel sometimes, like it's deja vu all over again. I say this frequently, but the market just feels like it's looking for some direction right now.
Yeah, I think you're spot on that, Mike. So we can look at the month of August with the markets generally speaking down, and so far this month, all the markets are down. But when you look at from the top to where we are today, 3%, Mike? 4, maybe 5 on the NASDAQ, but it hasn't been horrific. It hasn't really been stressful. It's been kind of orderly. And I think you're spot on when you said the market's right now just searching for direction. What is the Fed going to do? What's the inflation data going to look like? And we have some news primarily tomorrow. And I think that might, at least short term, give some of these markets some more definitive direction.
Yeah, the market went up too far too fast for the first 6 months of the year. The S&P was up almost 20. NASDAQ was up almost 30. So basically in the first 6 months of the year, the market retraced basically what it was down last year, 20 and 30%. And then we've been kind of in a holding pattern since then, since July 1st.
I think, Mike, year to date, the S&P now is up 16%, but we've focused on this in past conversations. Take out the Magnificent Seven or the 8 that some people lump up into that category, and the rest of the market's up 3, 4, 5%, right? So again, nothing horrific, nothing frightening. I think we're all looking at this picture and going, where's the economy going to be 3 and 6 months from now? And we're trying to make educated guesses on that.
So let's talk about energy for a second, because last year energy was the leading sector. And this year, not surprisingly, it was the worst of the 11 sectors. And now, Dom, it's creeping up. It's making a late year rally. Right now, it's the 7th best performer. Not great, kind of middle of the pack, but still up 7.2% since last Friday. So what do you owe the energy sector, kind of rallying here in the last couple of weeks?
Yeah, so there's two things, Mike. We had exited the energy space, took our profits last year and parked the money off to the side. Then we re-entered the space when it just seemed like the worst of it was happening in the market, and the energy sector has rebounded quite a bit from those lows. And a lot of it having to do with Saudi Arabia and the Russians agreeing to really limit the amount of oil they were going to put on the market. And, the U.S. and other countries have stepped up, but not enough to make up for the shortfalls. And some people estimate it could be over 1 million barrels a day short of what they were producing just a couple of months ago. So that spiked the price. Our concern is not so much the spike in price of energy, but what it does to that inflation number that the Federal Reserve is looking at. And obviously, it's had an impact already, Mike.
Yeah, so to your point, tomorrow the Fed makes their announcement, I believe, at 2 p.m., like they always do. And it's highly unlikely they're going to raise interest rates tomorrow. But a November hike is not off the table. I think even the Fed, with their 2% target, knew it would take a long time to get there. But inflation has come down quite a bit this year. But if it stays stubborn, if energy, stays stubbornly high, maybe the Fed does raise rates one more time before the year is over at their November meeting.
And that's honestly, Mike, the $1 million question. You hit the nail on the head on that one. look, our call from January of this year is inflation would fall, would really moderate by year end to a really low number compared to where we started. But really low number was 3 to 4%, not 2%. And this is the sticky part of the inflation that we're all worried about. Energy prices don't look like they're coming down anytime soon. And we see what's going on in the labor market, Mike, with strikes going on right now in Detroit and the United Auto Workers, strike out in California with the writers and actors guilds. Labor is stepping up to the plate and going, we have these higher bills to pay. We have higher costs to live, and we need extra money to do that. And once that happens, the companies give into these labor demands and pay their workers, then you have more embedded systematic inflation. And clearly, that's, I think, what the Federal Reserve is really worried about.
Yes. And to your point, especially with the auto industry, I feel like, right after the pandemic, 2021, a little bit into 2022, all we heard about was supply chain shortages. And cars were really expensive and they were in short supply. If this labor strike doesn't get resolved quickly, we may be right back in that again where, autos are in short supply because the assembly lines aren't moving right now.
And one of the biggest components, Mike, to inflation earlier on this year was the cost of used cars.
Mm-hmm.
So and that made sense. If they weren't producing new cars or enough of those, then, hey, there was demand for cars, they would have to buy a used one, right? So used car prices really kind of shot through the roof. And we saw that reflected in the inflation data. That's come way down. But if this strike continues for a considerable period of time, you're going to see a big spike in used car prices again, backing the Fed into a box where maybe they don't really want to be, but they may not have a choice, Mike. They just may not have a choice.
Which could be why, a November Fed hike increase is back on the table. And I also think, and we're going to get into this a little bit tonight with our guest, Jake Jolly from BNY Mellon. I think the Fed, for the most part, wants to be done with interest rate cycles going into 2024 and going into a presidential election year. I think they'd want to be out of the headlines about interest rates as quickly as they possibly can once 2024 begins.
And look, Mike, part of the same theme of how quickly the Fed wants to get this done. We've had some pretty heavy hitter Wall Street economists, portfolio managers that pretty much are talking about a recession the early part of next year. So this is an election year, I'm sure the current administration really does not want that in their election year, right? So they don't want that on their balance sheet that we had a recession. So if there's any pressure at all on the Fed, it's to get it done this year and be done with it. And if we go into a recession, maybe it'll be mild and over with pretty quick, certainly by the time the election rolls around in November.
Again, that's one of the topics I wanted to bring up with Jake Jolly. Will there be a recession? Will there be a short recession? No recession? I agree. There are a lot of pretty prominent economists predicting one. And then there's a lot of economists predicting we don't have to have one at all.
Yeah, so, look, we're still in the middle of this battle where again, I always like to point out, these are really smart people with a lot of resources behind them, a lot of research and analysts to look at this stuff, that speaking to companies directly. So I would say they have their pulse on really what's going on in the economic cycle. And yet I would say half of them are pretty adamant we're getting a recession. Half of them are pretty adamant we're not. We're tippy-toeing somewhere in the middle, Mike, because we're going to see how this thing plays out.
So on that note, we're going to take a quick break, and we're going to come back with Jake Jolly. He's been a guest of ours before. He's a great guest.
Fan favorite.
He is one of our favorites. He's a CFA, chartered financial analyst, and the head of investment analysis, global and macro markets team at BNY Mellon. We appreciate BNY Mellon always making Jake available to us, and we'll be right back.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner, Dominick Tavella, and our guest this evening, Jake Jolly, CFA, and head of investments and global and macro markets at BNY Mellon. Good evening, Jake.
Good evening, guys. Good to be back.
Welcome aboard, Jake. Happy to have you back.
So, Jake, I have an 8-minute drive to work. And this morning in that 8 minutes, I heard Janet Yellen interview the current Treasury Secretary, former head of the Federal Reserve. And I get it. She works for a Democrat. She was appointed by Joe Biden, and she was talking about how great the economy, not great, let me rephrase that. She's talking about how the economy is not terrible, how there's been job creation, the job market hasn't been destroyed, we haven't gone into a recession, pointing out some of the more positives in the market. And then the commentator said, then why do so many people think that the economy is so terrible? And there's definitely a disconnect somewhere between the data and the perception. So I was just wondering if we could start there and what your thoughts are on that.
Yeah, I mean, the first thing I'd sort of point to is, what we're seeing in the consumer surveys, right? I mean, you look at, doesn't really matter which one you look at, consumers are still pretty pessimistic, right? And that's been one of the key leading indicators that people have pointed to say, oh, you're going to see consumers tighten their purse strings because they're saying, they're responding to these surveys and saying that they're pessimistic about the future. Now, one of the interesting things about that is that it seems as though really the driving force behind that pessimism is the fact that people really hate inflation. So despite the fact that, the job market is very tight, people, in recent years have been getting very strong wage increases. They really just hate, paying higher prices for groceries and things that they're always having to consume. And that's being reflected, I think, in the consumer surveys, despite the fact that, they've been very resilient in terms of their spending. So basically, people are kind of taking and eating those higher prices, and then commenting that they're, not happy about it, but basically been putting up with it. Now, I think one point on sort of what Secretary Yellen is highlighting is the fact that, the market is really all about expectations, right? And the expectation was that this year was going to be, painful from an economic standpoint. And by and large, it's been just much better than many of us expected, right? I mean, my team had a much higher recession probability coming into this year. That obviously hasn't played out. Now, I will sort of put a caveat to that one of the reasons that we expected this to be a painful year was that we did feel that the really aggressive hiking cycle was going to bite and was going to have consequences. And, we went through a regional banking crisis that, for a very brief amount of time, I think was a little bit scary. There was lots of echoes to the global financial crisis. And I think at the time when we were going through it, we thought, okay, these tighter credit conditions, this is going to feed into a slowdown in the near term. But it seems that, the policy response was substantial enough through that period that, basically markets were able to get through it with some confidence and pretty quickly things were kind of able to, carry on, and that you didn't really see the slowdown that we really expected on the backside of that. And you can also throw in there, the debt ceiling, raising the debt ceiling. There was a lot of, talk, a lot of brouhaha about that, but ultimately the market expected it to get done. It got done. So we've gone through sort of these hurdles at the same time that the labor market is held together much better than people expected. Earnings this year, haven't been amazing, but they've held in there, I think, better than people feared. So really, if I had to sort of put it in a nutshell, the reason that really the market has been doing much better than people expected too is that we were expecting this to be a challenging year, and by and large, it's been much better than expected. And really, even in sort of this quarter, we've seen sort of that expectations for accelerating growth. So we have quite a bit of momentum, more than I think people expected at this point, and I think that's kind of what Secretary Yellen's comments are really reflecting.
So, Jake, I just want to push a little bit back on that, and then we can move on. But Mike mentioned the word disconnect, but is the disconnect coming from the political side or the consumer side? And the reason I'm asking that is the consumer represents 60-70% of this economy, and when they're not happy about going to the gas pump and filling up their car, or going to the supermarket and buying steak, or going to a restaurant, or going to buy a 2x4 at a Home Depot or a Lowe's, that affects their spending. So is the disconnect that the administration's not seeing the level of unhappiness because people are paying higher prices? They haven't really come back down. Or is the disconnect the consumer that, well, you're making a lot of money, you got a job, get over it?
Probably a little bit of both. But, we would put it, or the way we would sort of summarize it is to say that, we care more about the actions of consumers than what they say in their surveys. And even though the surveys have been a bit misleading through this period, I think the fact that the job market has been strong, the fact that we know we were sort of whittling down this excess savings that we had coming out of the pandemic, those things we think are going to be a bit more difficult going forward. We expect to see softness in the labor market. We expect that excess savings is going to go away here. And then you add to that, the restarting or the ending of the student loan moratorium. The fact that, you guys already mentioned oil prices, that does, even though the Fed will say that they look through that, you do expect that if oil prices stay higher for longer, it's going to feed through into other prices as well. So the fact that, there seems to be this disconnect, I think at some point, that pessimism, if it feeds into an actual slowdown in the economy, will start to line up a bit better. But obviously, things that are said by, politicians are going to have a political bent. So you have to sort of take that with a grain of salt. If things are better than expected, they're going to say that they're a lot better than expected, and that the economy is humming along. And maybe not to front run some of your questions about going into next year's election year, but obviously avoiding a recession and keeping the economy strong is really key to Biden's reelection campaign.
Well, there's the old saying, Jake, that, at the end of the day, people vote with their wallet.
Yeah.
And I think the majority of the country is not thrilled about either candidate who the Republican candidate is Trump, and we know unless Biden gets challenged. So at the end of the day, if they have to hold their nose, the likelihood of them voting with their wallet is high one way or the other, correct?
Yeah, exactly. The historical record on this is very clear, right? If you want to win a re-election, you basically can't have a recession in the second 2 years of your presidency. The Democrats know that. But you're right. I mean, at the same time, we look at, the front-running Republican candidate, you look at Biden, we have very unfavorable ratings for both. Which is, I was actually reading an article today, basically going through, there seems to be more and more talk about a third party candidate having a real chance. Now, Washington and all that isn't my area of focus, but it is interesting. And certainly I think, expectations are for this to be a very chaotic election season next year. But at the end of the day, my position, my expectation is that ultimately it does come down to the economy, which is why we're focused on discussing that.
So Jake, I'm going to pick up right where you left off. I mean, myself and Mike's all the time talk about headline risk, and you mentioned some of this. We got a federal decision tomorrow on interest rates and commentary, and the strikes around the country. That's not helping the situation. But you brought up a really important point. Earnings have held up pretty well, a lot better than some of the experts had called for at the beginning of this year. So let's take a minute and talk about the glass half full for a second.
Sure. Yeah. So the glass half full is that, we came into this year, or even starting at sort of the middle of last year, you started to see earnings expectations marked much lower. Right. And at this point, we're through 2 quarters in terms of earnings results. So it looks like we're on track to basically have, for S&P 500 earnings kind of flat to maybe slightly negative, maybe slightly positive, depending on how the end of the year plays out. And that is, that's a win, because earnings had been really strong coming out of the pandemic. And given, those expectations around a slowdown this year, the fact that we can hold earnings and kind of, tread water, as I said earlier, really is a win. And that's why the market has been able to progress. Obviously, AI enthusiasm and sort of the big tech names really carrying the day has been a big part of that. But the fact that you look at equal weight S&P 500 and it's still up, 3 or 4%, I think is really sort of an indication that, okay, well, earnings were expected to really struggle. Everybody was kind of talking at the beginning of the year about that being the next shoe to drop, and they really held in much better than expected. Now, the market, of course, is all about forward looking, right? It's not about where we've been, it's where we're going. And when on that front, what's being priced in for earnings is a pretty optimistic view, right? So we have basically earnings staying flat for full year. And then in 2024, getting back to pretty strong growth, about 10, 11% earnings growth in 2024, right? So that sequential growth from right now through 2024 is really pricing in a pretty optimistic view. So at this point, it's really going to be about making sure that we see that follow through in terms of the earnings. And it's certainly possible, but we definitely need to avoid an economic slowdown to get that kind of earnings growth that's currently being priced into the market.
Jake, does that mean, that the hope would be no recession, no landing, or would a soft landing, still get us through those optimistic earnings projections?
It's a good question. I think, the simplest way to put it is you need the labor market to hold together. Dom already pointed out 70% of GDP is coming from consumer spend. Generally, people are going to continue to spend and remain relatively optimistic if they have jobs, and the labor market has just been very, very tight, right? We've seen some labor supply come back, which is a good thing. And from the Fed's perspective, they are, we'll, I'm sure, discuss this and we'll get to it, but they are looking to hold at this point because they are trying to thread a needle. They are trying to deliver that soft landing. And really, it is a bit black and white, because if we do have a recession, if you do have unemployment start to jump higher, pretty unlikely that you're going to have earnings grow by 10% next year, right? Because it's going to hit consumer spending. You're going to see companies start to protect their margins. And how do companies protect margins? They protect margins by laying off their most expensive line item on the income statement, which is employee cost. So, the no landing idea, I've always been a little bit skeptical about, because to me, the economy has to land at some point. And by landing, I mean that monetary policy has to normalize, right? We don't think that Fed funds rate is going to stay above 5% indefinitely. So the landing is really about, okay, we've hiked rates. Inflation has been on this nice disinflationary process, but at some point we need to start bringing rates down. So right now the market is expecting that those cuts are going to start coming in the second half of next year. The real question now is, okay, is that going to happen with the labor market still tight, with growth still in healthy positive levels, or rates, I should say, or are they going to have to start cutting because they see real weakness in the economy? And if they see real weakness in the economy, that's the risk for the earnings outlook.
But Jake, I think you would agree that the consumer would really have to stop spending in order to the economy to really shift into a real negative situation. And we've had a bunch of layoffs, and companies have seemed to trim at the margins. We had one significant layoff with a trucking company, a national trucking company, but sort of this strike right now in Detroit, it's hard to believe that we would see mass layoffs by companies, labor being so tight. So if labor stays relatively speaking strong, again, we might see some layoffs at the margins. The consumer, even if they redirect their spending, but they will continue to spend. It's hard to envision like a real deep type recession unless we had a global event.
No, I agree, and certainly, we've become more optimistic over the last several months. I already mentioned kind of the regional banking crisis earlier. I would say that going through that was kind of where we were peak pessimistic, because we were concerned about an imminent credit crunch. We were concerned about provision of credit to the economy, and we know that historically, if put the brakes on provision of credit, the economy slows pretty quickly. But thankfully, we're not seeing a lot of evidence of that. You are still seeing in senior loan officer surveys that they are expecting credit conditions to tighten, which the Fed probably looks at and says, okay, this is actually a positive, right? This is how we slow down the economy. But at the same time, you're still seeing, resilient consumer. Retail sales have been very positive. You look at real-time measures of GDP activity for Q3, very strong. And then, as you said, the labor market is just still very tight. You're not seeing evidence of those mass layoffs. So yes, at the beginning of the year, you kind of saw it specifically within tech, right? We know that tech probably overhired coming out of COVID, so not that surprising that came down. But by and large, companies are comfortable, or trying to stabilize and keep their workforce as is, because things are pretty good, right? Because earnings have, there's the virtuous cycle to this, right? So our concern, I'll say that I'm optimistic, but then I'll pivot pretty quickly to say, I get paid to worry about the risk and what bad things are going to happen. The concern is really around, the mantra from the Fed is all about higher for longer, right? And our view is that having rates higher for longer, the cumulative effects, there's a risk to that, right? The longer we have to stay at these high rates, you do have, more and more companies having to, refinance as their debt matures. And those things do build up, and you have a risk, the longer it lasts, there's still that risk that those long and variable lags of monetary policy start to really bite. And the concern is that the Fed won't be able to fine tune things on the way down, right? The problem with monetary policy is that it's a pretty blunt instrument, right? It's not a scalpel, it's much more of a hammer. So the concern is that they've been hammering on the economy with these high rates and things have been holding in pretty well. The concern is that they won't be able to quickly react and fine tune and cut rates, fast enough when they do start to see weakness.
Jake, thanks for that answer and that explanation. Let's take a quick break, and then we'll come back with more of our conversation with Jake Jolly.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back again with my partner Dominick Tavella and our guest this evening, Jake Jolly, CFA, Chartered Financial Analyst. That's, by the way, a very difficult designation to achieve, so good for you.
Thank you.
Jake is the head of investment analysis and global and macro markets team at BNY Mellon. And Jake, there was a great analysis at the end of the break about credit markets. I know, Dom, you wanted to have a follow-up question to that.
Yeah, Jake. So just to maybe to kind of help our viewers and listeners understand it, we talked about the consumer and healthy, and that's the glass half full. But one of the things that scares me, and both myself and Mike have seen this in our own practices with small businesses, they're having a hard time getting lines of credit, maintaining lines of credit. And in some cases, the lines of credit just get canceled by the bank. So if businesses can't get access to credit or it's restricted, that could be a significant event in economic growth.
Yeah, I mean, this is, the way that monetary policy is meant to work. Unfortunately, it's raising the cost of capital means that the marginal activity gets more expensive, and you might not do that activity, right? And you can see it through, higher credit costs or tightening lending standards from financial institutions. So our concern is really around, again, back to that kind of point that I was making about the Fed not being able to fine tune things. Trying to do this in a moderate way is very difficult. It's there are risks to raising rates to 5.5% and leaving them there, because it's going to have a big impact on certain economic actors. And certainly, since we've started this, and by the way, it's not just a US hiking cycle, it's really a global tightening cycle, right? The first sort of instance of a credit event was really the mini budget crisis in the UK, or the gilt crisis, whatever you want to call it, right? And that I would say was sort of the first instance. And then obviously the collapse of SVB is sort of the second most notable one here in the US. But really, it just points to the fact that, anytime you increase the cost of capital, increase interest rates this fast and leave them there, there's going to be consequences. And there are, there's that risk of, unforeseen vulnerabilities or sort of, those negative consequences that, the Fed, the goal is to reduce inflation. It isn't to, put companies out of business or they would like to not have the labor market weaken significantly. But that's one of the major risks. And right now, the Fed is much more focused on getting inflation back down to control, and they're willing to risk the economy, right? They're willing to say, look, we need financial conditions to be tight for an extended period of time to make sure that we really wring out any, inflation in this economy. And the good news is that we've come a long way in this disinflationary process. But the Fed also knows, from history that there are risks to these second round effects and the second wave of inflation. And that's one reason that we think that, this higher for longer mantra really does have risk, because they're basically saying, look, we don't want to risk having a reacceleration of inflation, and we're willing to basically over tighten and leave rates higher for longer, even if that means there's risk to the economy, to make sure that we really take care of inflation in one go. And Chair Powell kind of said this pretty explicitly, not at the most recent Jackson Hole, but a year ago, when he basically said, like, I think there's going to be economic pain with this, so expect economic pain. The interesting thing is that so far we really haven't had that economic pain that he was forecasting, and that's a good thing. But
And Jake, all Fed Reserve chiefs are creatures of their predecessors. And I think Jerome Powell, Chairman Powell, alluded to Paul Volcker in the 80s, where he stopped and started and stopped and started. And the next thing you know, interest rates were out of control, right? Hopefully we never see those rates again. So here we are. The Fed met all day today. They're meeting tomorrow morning. They make the announcement at 2 p.m. So the expectation is they're not going to raise tomorrow, but people are going to be hanging on Chairman Powell's every word going forward. So what's your prediction on where we are based on what you just said about interest rates in general?
Yeah, well, so I checked markets before I came in here, and it had a 99% probability of no hike tomorrow. So based on Fed futures markets. So that's pretty certain. This is a Fed that doesn't want to surprise either positively or negatively. So if they were going to hike, they would have, leaked it somehow in the past week, and the market would have priced that in. So very, very likely that you're not going to see a hike tomorrow. But I do think that the communication is still going to be quite hawkish, right? So they are going to be pausing, but they are essentially going to try and, as much as possible, leave the door open for hikes down the road. So probably the language you're going to hear is that November is a live meeting, right? That it's still on the table. They're going to monitor the incoming data. They're going to be data dependent. At this point, I think most Fed members are pretty comfortable that they are sufficiently restrictive, because they've seen evidence that inflation has continued to come down. The most recent report that we got was more or less in line with expectations. Yes, we had an increase on the headline rate because of the energy prices, but what the Fed really cares about is that core number. And on the core measure, we had a month-on-month gain of 0.3, which is still a pretty decent number on an annualized run rate. So I think they are comfortable with how things are progressing. And as we were discussing earlier, they're not looking to force a recession. They're really trying to thread a fine needle here. So as much as possible, they are going to take the time, see how the economy evolves before having to decide whether they need to raise rates. So in our view, the likelihood of a hike in November is probably still about 50-50. That's a bit higher. I think market pricing is a little bit below 30% probability for November, but a lot can happen before November. And At this point, beyond that, there's no expectations from the market that you're going to see any more hikes, and in fact, that you're going to start to see cuts by about mid next year. We would say that there's a bit more of an upside risk there, just because we think that inflation's still likely to be a bit stickier, that you're going to see a bit more volatility in inflation going forward, which does put a bit of more of an upside risk on sort of Fed funds rate. But by and large, tomorrow is maybe not going to be a whole lot of fireworks, because I think he's going to stick to the hawkish skip or hawkish pause, whatever you want to call it. But there might be some information in the summary of economic projections. So they will update their forecasts, which we shouldn't really call them a forecast. It's really just kind of a collection of the Fed's views and aggregating them. But I would expect that you're going to see the growth outlook upgraded based on the latest data. You're going to see the unemployment rate downgraded or improved. And by and large, that's going to be sort of painting a picture of an improving economy. But of course, it has to be within the context of continued progress on the inflation front.
So, Jake, on that note, I'm in agreement with you. I don't think they raise tomorrow. And I'm also in agreement that they're probably going to come off pretty hawkish. Does that spook the market? Does the market go, whoa, wait a minute, November really is on the table, assuming they go down that road? Does that spook the market short term?
It could, if he says anything that raises that problem. So I mentioned earlier that Fed futures is priced below 30% probability for a hike in November. If he says something that pushes that above 50%, so basically puts bakes in a hike expectation for November, that would certainly be a negative, because it'd be a risk off event. Now, I'm trying to think kind of what he would say. I seriously doubt he would commit to that, right? I mean, if anything, Powell has done a very good job of being non-committal, and I suspect that he wants to keep that optionality for November, and he will try to say we've continued to make progress on the inflation front, but we're not out of the woods. So, if we do see a reacceleration, if we start to have concerns before November, we might have to hike. But if things continue to progress as we've seen recently, we probably don't. And it'll be up to the market to kind of read, how he's weighing those two things. But again, I think his bias, and this goes for all Fed members, right, is sort of a risk management approach. And the risk management approach is basically to say, I'm going to communicate hawkish views because I'm trying to keep financial conditions tight. I don't want to sort of inadvertently work against my efforts by saying things that are interpreted as being dovish, such that the market might start pricing out hikes and start pricing in cuts sooner, right? Because that ultimately works against sort of the fight against inflation. So I think it's going to be a pretty boring script if you're a seasoned Fed watcher, but that's why we have to listen, right, to see if he lets anything slip.
Jake, I want to follow up on what you said about the possibility of interest rates starting to actually go down sometimes, maybe in the middle of next year. So short-term treasuries, 1 year or less, have been the gift that keeps on giving for a while now, still paying well over 5%.
Right.
So do you have any idea or any expectation when the yield curve kind of gets, right-sided up and out of this inversion?
Yeah, so, we would say, and I kind of already touched on this, that there's probably a bit more upside risk to rates than is currently being priced in the market. We see the market as being pretty benignly priced and pricing in a very, expectations of this disinflationary process being pretty clean. So we call that immaculate disinflation. And it's really just an extension of what we've kind of seen over the last several months. We think it might not be quite as smooth going forward because of a few things, oil prices being sort of the most obvious one here, but also the fact that you're having some of those base effects from last year that really were helping on the downside. That starts to get a bit more difficult going forward. But out beyond sort of that near term kind of upside risk, we actually see a larger probability of a significant down move in rates, and that lower move in rates is really tied to the fact that we, do have a higher probability of recession next year, probably higher than consensus. But we sort of see that as being, really playing into this argument for why you do want to start extending duration, because we think that, the short rates are obviously tied very closely to Fed policy. So if Fed policy is going to move more aggressively to cut in a recession at some point next year, that short end is going to move quite aggressively. So, that's always been the risk. I completely agree with you that, that the cash, the short rates has been the gift that's kept on giving, and we still really like the short end. But we do acknowledge the fact that, rolling into 2024, if we do start to see some economic turbulence, if you do see sort of that the Fed, acknowledging the economic weakness, those short rates can go pretty quickly, right? So, that's why we, are definitely liking, moving out the curve, potentially taking a barbell approach to getting duration exposure.
So Jake, just to get a little wonky on that, we watched the 10-year Treasury get up now to about 4.3 and change. And that's been the higher end of the range for the year. But there are some, again, use the word loosely, experts that are saying, hey, we could see 5%, 5.5% on the 10-year, which we don't even want to talk about what that does to mortgage rates. But what would it take to get the 10-year that high?
It would take the terminal Fed funds rate needing to go up by another 50 to 100 basis points or something like that.
And that means the Fed aggressively
raising the Fed has to,
right
you would need a pretty notable reacceleration in inflation and kind of a knee-jerk response from the Fed to reassess, right? Because, one of the interesting things about, sort of the second half of this year so far has just been the sort of stability that we've actually seen in terms of those Fed funds expectations, right? We had, terminal rate expectations swung around a lot during the regional banking crisis, but then we sort of steadily climbed and got back to this level of being, okay, expectations are for sort of this 5.25 to 5.5, right? And tying this back to the summary of economic projections from the Fed that we get tomorrow, that's going to be one of the things that the market's really focused on, is whether they keep in that expectation for one additional hike, because that's what they had in their last summary of economic projections. Whether they keep that in there or whether they pull it will be one of the interesting things to look at. But this expectation of folks saying the possibility of the 10-year going to 5%, that really only happens if you have a notable step up in that terminal rate. Because right now, where the terminal rate expectation has been kind of sitting at this between 5.25 and 5.5%, it's putting a cap, I think, on that longer end rate, right? We've seen, the 10-year go up. It's been volatile. Obviously, it increased quite a bit in August. It came off, but to me, it's finding some stabilization at these levels. And I would say without a significant increase in expectations around the terminal Fed funds rate, you're likely pretty range bound at these levels. And then I would go back to the last question, which is to say, we don't expect those high rates to last, right? So that's one reason that we like locking in these rates for, multiple years, because we think that next year there's a higher probability of a larger downside move than upside, right? And really the markets is all about, okay, what's my probability for, the move up versus what's my probability of the move down, and what's the time horizon. And we think that next year, whether it's through the Fed starting to normalize rates, so starting cuts because we get a soft landing, or because they need to cut aggressively because you're starting to see that economic weakness and going into a recession, both of those things I think are going to bring rates down. Now, that doesn't mean we're going back down to the zero lower bound like we were during the 2010s, but I don't expect that the 10-year is going to be trading at these high levels for multiple years.
Jake, Dom mentioned mortgage rates, and he's right, 100% right. Mortgage rates are, higher than they've ever been. A lot of home buyers have, sticker shock. But in spite of that, the housing market has stayed relatively strong, especially here on Long Island.
Yeah.
And I think one of the unintended consequences of these really low interest rates we enjoyed for years is people who might have sold their home, who might have downsized, are unwilling to give up a 2.5% or 2.75% interest rate. I've read a couple of articles about that. I've heard a couple of economists speak to that. Do you agree with that theory?
I do. And I mean, you can kind of do some just back of the envelope math, right? For people that are locked in at pretty low mortgage rates, if they wanted, they wanted to sell their home, the sort of reap the equity that they've gained from higher housing prices, it's very difficult for those individuals, even if they were willing to take on a much higher mortgage rate, to maintain their monthly payments, right? Mm-hmm. To me, it really all comes down to, okay, if they're paying, X dollars on a monthly basis for their interest and principal, are they going to be able to sell that home even at an appreciated value and move into some place that's bigger and better, right? You imagine that they're move up in quality, even if they're downsizing, and maintain the same monthly mortgage payments. It's very difficult at rates that are this high, right? And I think that that's really slowing things down and basically making, folks that want to be home buyers, they kind of have to buy new constructions, right? And I think that that's, definitely supporting activity, at least in sort of the new construction part of the market. Whereas, the existing home sales has been, more challenging, definitely for home buyers. And I think, we did have, if you look at sort of the home builders indexes, right? We had kind of the expected pullback. Then we had some stabilization. We have a little bit of a rebound. Now it's kind of unclear where we're headed. But I think you're right. I mean, the normal dynamics that we would expect to see in the housing market with this amount of tightening, right? There's kind of that old saying that the housing market is the business cycle, right? So, why isn't that maybe playing out the way we expected this time around? I think it's the fact that we had so many years of people, buying homes at these very low rates. And the fact that we've just had this aggressive run up that, people are kind of sitting on the sidelines expecting it not to last, right? I mean, people, again, it comes back to expectations. If you expect this not to last, I'll wait it out for a year.
I'm glad you brought that point up, and I'm sorry to cut you off, but yeah. I'd like you to maybe hear our clients hear a different voice. So we have clients sitting on the sidelines, not only sticker shock in terms of the mortgage, but sticker shock in terms of the price of that house. Now, we don't have the lines anymore with 20, 30 people over bidding on prices, but prices have maintained relatively high levels. And clients, some of them are sitting on the sidelines going, I'm just going to wait for it to come down and maybe get a better opportunity. What would it take for prices to come down and come down significantly?
Probably a recession. But then the old joke is, okay, well, who's going to sell in a recession, right? The sellers go away in recession too. So I definitely not a housing expert by any means. But I think, this has been one of the challenges for the Fed because, that's one of another key channel through which they tighten financial conditions. But the fact that you're still seeing those home prices as high as they have, because I think it's kind of the legacy of rates being low for so long, it's, proving to make the Fed's job a little bit more difficult and this business cycle just to be a bit more weird, right? I mean, it's kind of like, well, COVID, we're still dealing with kind of the kind of crosswinds from that. Well, then we also have the fact that the housing market went through this long period and kind of built up these, how many individuals are on very low, 2 and 3% mortgage rates. I think it makes it interesting for me as a strategist, kind of looking at these things. But I think it's also makes it more difficult to forecast, right? Because I think if you had told me, that mortgage rates were going to go to 7%, I would expect the housing market to be much weaker than it is right now, and it's not. So, why is that? Why is it holding in? I think it's probably safe to say that it's bundled in with the fact that the consumer has been more resilient. As you mentioned,
and the unemployment numbers have remained historically low.
Exactly.
Jake, every financial advisor, economist, and portfolio manager hates the expression, it's different this time. Right? Yeah. And I'm not saying it's different this time, and we have about a minute to go, but this economic cycle just seems to be a bit of an outlier.
Yeah. So, my joke is that if I don't want to say this time is different, I say this time is not the same. So I think, the way to think about, and this is, the benefit of being a long-term investor is to try and, really see things in time, sort of the arc of history, right? Really try to pinpoint those major inflection points more so than getting kind of caught up in a lot of the noise and kind of the daily news flow. And I think, as I said, we were much more pessimistic several months ago. Now I'd say we're, still, cautiously optimistic, because we would say we're surprised that we haven't, seen a more notable slowdown, that activity has been holding up much better than we expected. But we don't think that we're out of the woods. We think that, we're still, facing tighter financial conditions, and we have to acknowledge the fact that, historically, when you see tightening financial conditions and these hiking cycles this aggressive, they typically end in recessions, because it's very difficult to fine tune the economy and soft land. So we have to be kind of realistic about that, right? We have to play the odds. We have to adjust our probabilities, but also sort of keep it in the longer term context that, look, you go through business cycles. This one is certainly playing out a bit differently. So it's about sort of weighing the evidence that suggests, okay, this could be different, against sort of that historical evidence that says, okay, well, you still have a lot of leading indicators that point to a slowdown. You have a Fed that is saying, nope, we're going to hold rates at this high. They're not saying they're going to be cutting anytime soon. And all of those things to us mean that the economic outlook is still pretty challenging. It's definitely not, risk on, go, go, go. But I think it is a bit more optimistic than it was a few months ago.
Jake, we have to end it there. We can't thank you enough for jumping on board and talking to Dominick and I, and to our listeners and clients. So thank you.
I'm
Thanks,
happy to
and
do it.
have a great evening. Much appreciate your time, Jake.
Thanks, guys.
And we will be back next week. And we're out of time tonight. Have a good night, everybody.
Good night, all.